Assalamualaikum and good day to our lecturer and fellow classmates. Today for our FIN project, our group will presenting a comparative financial analysis on two of the world's biggest rival, which is Samsung and Apple. Before we dive deeper into analysis, let me introduce our team member. We have Rashdan, Wafi, Awanko, Aidil, Azhari and Fazli. Let's start with a brief background. Apple is an American tech giant famous for premium hardware such as iPhone, Mac, software and ecosystem driven by an asset-like outsources manufacturing model. While Samsung Electronics is a vertically integrated South Korean conglomerate leading in semiconductor, memory chip, and consumer electronics through heavy internal manufacturing.
Let's start with liquidity ratio. Based on the trend from 2021 to 2025, Samsung consistently recorded higher current and quick ratio than Apple, indicating stronger short-term liquidity throughout the period. Apple's liquidity ratio remained below 1 for most years and its net working capital became negative after 2021, while Samsung maintained positive working capital across all 5 years. Overall, the trend shows that Samsung had a stronger and more stable liquidity position compared with Apple.
Net activity ratio. The data highlight a massive fractional gap in operational velocity. Apple utilized an asset-light, outsourced manufacturing model. This allowed them to maintain an exceptionally fast inventory turnover of 33.98 times and a short collection period of 34.89 days in 2025. Samsung conversely relies on heavy internal manufacturing and direct ownership of factory hub. Consequently, they operate on a much longer inventory and collection cycle. Ultimately, this shows in their total asset turnover. Apple efficiently turns over in entire asset base more than once a year, peaking at 1.15 times, while Samsung tracked lower at 0.62 times due to its large asset base.
For the leverage ratios, Samsung's perform better in debt ratio and debt to equity ratio because it relies less on the liabilities. In 2025, Apple's debt ratio was 79.48%, while Samsung's was only 23.04%. Apple debt to equity ratio was also much higher at 3.87 times compared to Samsung's 0.3 times. However, for time interest earned, Apple performed better in 2023. The latest year where both company can be compared, which 29.06 times compared to Samsung's 7.06 times. Based on the overall analysis, Apple should focus on improving liquidity and controlling leverage because its current ratio and debt ratios are weaker than Samsung's. However, Apple should continue strengthening its high margin services and also premium product segments because its profitability is strong. For Samsung, the company should maintain its strong liquidity and low leverage but focus more on stabilizing profitability because its performance dropped sharply in 2023. Therefore, Apple's main recommendation is financial stability, while Samsung's main recommendation is profitability consistency.
Next is the profitability ratios. Specifically, we look at three levels: gross, operating, and net margins. Let's see who managed their money better. First is the gross profit margins. This shows profit after only deducting the cost of making the products. As you can see, Apple is more stable, Samsung is more affected by market cycles. Next is the operating profit margins. This is what left after paying for things like R&D, marketing, and office rent. The table shown Apple turns sales into operating profit much more efficiently than Samsung. Finally, the most important one, net profit margin. This is the take-home pay after all expenses and taxes are paid. By comparison, even at Samsung best, Apple profit margin is nearly double this.
So looking at the profitability ratio from 2021 to 2025, we see a massive divergence in how effectively Apple and Samsung generate return from their equity and asset. Apple delivers strategic triple-digit return on equity, peaking at nearly 197 in 2022. Their return on asset remain incredibly stable and efficient, constantly hovering between 25% and 31%. Samsung operate on how much cycle model they are met in sharp low in 2023, with ROE dropping in just 4.26. They show a steady recovery leading into 2025. While Apple used an aggressive high leverage strategy focused on lean working capital, high debt and massive shareholder returns driven by immense pricing power, Samsung relies on a conservative, highly liquid equity funded model to buffer its industrial manufacturing operation. Consequently, Apple maximizes asset efficiency and profitability, whereas Samsung prioritizes capital resilience to weather market cycle and internal economic shocks.
We believe that's all for our presentation. Thank you so much for watching. Have a nice day.